Iain, always a pleasure to see you in the morning. Thanks for joining us. If you look at volatility, right, it looks like you haven't actually got back to anywhere near April 2nd levels. It kind of suggests that there is optimism, there's going to be room for negotiation in these trade talks. You can see it in the gold price too, down as well. Is this optimism on trade misplaced, do you think?
I don't think so. I think what the market is learning, and you said it very well, the market's got a bit of fatigue around tariff headlines and the news flow that's happening. And what the market's learning is that there is room for negotiation. We've had an extension again. We're now talking August 1st. We've got another 3 weeks for people to be negotiating with the US. And that's exactly what they want. So the president, he wants to keep up the rhetoric. He wants to continue to put pressure on the countries that he wants to do deals with. But I think the market's saying, ultimately, what they do want is they do want deals. They would prefer to do that than be slapping on these very high tariffs. So at the moment, we are seeing a reasonable amount of calmness. Now, again, if we get closer to August the 1st and nothing has happened, then I can see some volatility picking up. But I think we've got a couple of weeks for more conversations and more discussions to be had.
But Iain, when Trumponomics assumes that tariffs will help at least to pay for tax cuts, is it wrong to assume that much relief is actually coming on August the 1st? Is that perhaps why we've seen him stepping up on copper tariffs today?
Yeah, maybe we don't get a huge amount of relief from where we are. And actually, the reality is the sort of average level of tariffs is probably going to be a little bit higher come the end of the day. But I think what we're not going to is back to those levels that we saw early April, where we were talking in the mid-20s and those really high levels on China. I think that's what the market is taking comfort from at the moment, and that's why we're not really seeing a huge amount of volatility this week when, you know, historically, if you'd said this was going to happen, you would have expected the volatility to be picking up, but we're just not seeing it at the moment.
And of course, like everybody else, the Fed doesn't have any clarity because of this deadline extension. Does it stop them cutting in September?
I think really September is going to be very much down to the jobs report, and we had another report, or the employment picture. We had another jobs report last week, which again, I think the market had set itself up in anticipation of a weak print. And under the surface, I don't think it was particularly great, but obviously it wasn't as bad as maybe was being feared. I think that's going to be the big factor that really will lead to the Fed making the decision whether it goes in September. Are we seeing weakness occurring in the employment picture? Currently, with an unemployment rate of 4.1%, it's hard to argue that they need to be very aggressive from here.
And what level of average effective tariff rate, and we're trying to guess where it lands, is going to be high enough to harm corporate credit stateside?
It's really difficult to say that because we just don't know exactly how much tariffs are going to be passed on. You know, corporates are in a very strong position at the moment. You know, margins are very elevated. When our credit analysts have done the analysis and they looked at 10% tariffs, they looked at 20% tariffs, both of them did cause a sort of a falling off in earnings, but ultimately it wasn't the recessionary numbers that you'd have seen through previous slowdown periods. So I think actually credit and corporations will be able to withstand these tariffs. I think what will be very interesting for us to look at is, I say, what gets passed on, what has to be absorbed by the consumer, and then what are the consumer spending patterns once we know that information. And again, it's going to take us a little bit of time to see that all come through into the data.
Iain, I don't want to neglect the fiscal story here. Of course, we've got the trade headlines dominating, but we're still looking out for the bond vigilantes. There's no sign of them at the moment. Do we basically conclude that this is a president who can do whatever he likes fiscally as long as he funds it with T-bills?
I'm not sure I'd say he can do whatever he likes fiscally, but ultimately I think this is where, when I look at it, tariffs are here to stay, because ultimately the bill is going to create an additional spending that's requiring funding, and they're going to use the tariff revenue to fund a lot of that. What it does mean is, though, that you'll see, I think, in the US, what we've seen in the UK and what we've seen in Japan is where the Treasury will be looking at issuing more in the front end rather than the longer end and trying to keep funding costs down. I think it will be interesting, though, to see as to what the private sector says as to what level they're willing to buy those bonds at, even in the sort of the more intermediate types of the curve. Because ultimately what we've been seeing over the last couple of years or so is that the public sector, through quantitative tightening, through no really additional of currency reserves, they're not they're not the main buyers. They're not the price setters of government bonds anymore. It is the private sector. So what are they willing to pay for it? I personally think 4.5% on a 10-year Treasury, though, is a pretty good level.
But, you know, when you've got a president pressuring the Fed to cut rates, calling Jay Powell most recently a baby, isn't that a classic case of fiscal dominance?
Yes, it is. But I always say, though, be careful what you wish for. Because we saw back in September of last year when the Fed did do the oversized cut of 50 basis points, and then the market said, actually, you know what, maybe the US economy didn't need that. And we saw 10-year Treasury yields move 80 basis points higher over the next couple of months. Now, there were some other things going on. Obviously, there was the election and there was the movement towards the current administration. But I do think in this current environment where we do know that, or we do expect at least inflation to be picking up over the second half of this year because of tariffs, and the employment picture still looks in a pretty good spot, although maybe there are, it's trending slightly, it's slowing off. I think, let's be careful. If you cut rates aggressively at the front end, I do think that could lead to actually back-end yields, which is actually why I would still advocate curve steepeners really across the globe.
And Iain, you're in London. I've got to ask you about this long-end gilt sell-off that we saw last week. Things have pretty much recovered, but the Chancellor's fiscal woes have not. What could be the next catalyst for a gilt market puke that could spill over to the rest of the world?
I think it's still a concern around the state of the fiscal situation in the UK and how they're going to fund it. And if we do see slowing growth, then ultimately there are concerns around the growth trajectory, concerns around the growth trajectory in the UK. Now, if at the same time we start to see service inflation come down and we start to see the Bank of England being able to be more proactive on rate cuts, and I think that could well be the case as we move into the second half of this year, then actually I think the gilt market also looks pretty attractive at the moment. But I say, exactly as you said, though, there was a bit of a wobble. We had a bit of a concern around that, and obviously the government stepped that back. Said, yes, Reeves is going to continue in her role. And I think that did give some comfort to the market. What the market doesn't like is uncertainty. So if we get a bit of stability and we do get more of a sense of the Bank of England being able to lean into this, then actually, I think gilts look quite attractive at these levels.